Tiempo de analizar el mercado, tiempo de buscar oportunidades, y esta mañana nos acompaña Supriya Menon, responsable de estrategias de multiactivos, EMEA de Wellington Management. Supriya, good morning.
Good morning, buenos días. How are you?
Gracias, thank you for being here in Negocios Televisión. I would like to start, what are the opportunities and risks in the US market following the election results?
Thank you for that question. So the environment we've been in over the past year or more is that the remarkable gains of the US market are very much fueled and supported by quite a narrow group of companies, the very large, magnificent 7 tech and media companies, which has been fueled by really strong earnings growth, and it's outpaced the rest of the market. Now, looking forward into 2025, what we'd expect post-election is that we see a shift in this mix of profit growth. So you see broader outperformance in other areas of the market beyond the Magnificent Seven. So tech growth will remain robust, but the rest of the market in the US will catch up. And we expect stronger earnings growth, more broadly shared. Now, what this means for portfolio managers, we manage multi-asset portfolios, is that we find more attractive investment opportunities across the market as a broader cohort of companies leverage the benefits of AI. And when it comes to policy impacts following the election, we are positive on areas such as financials, small and mid-cap, deregulation and potential tax cuts also likely to be helpful here. The only risk I'd lay out there is that the path of inflation is likely to remain a bit bumpy in the US, so that complicates the picture for further Fed rate cuts.
What do you believe US equities offer better prospects compared to Europe and Japan?
Yeah, we are overweight the US market relative to Europe and Japan, where we're neutral at this point. Now, quite simply, this is because of a more robust macroeconomic picture. We call it US exceptionalism, that will still be in place in 2025. So there'll still be a gap between the US and other markets, like the European markets, although with a smaller gap. So that will, US exceptionalism will still remain in place, but to a lesser extent. Now, this is because the macroeconomic picture is stronger. Tax and regulation policies also align in the US's favor. So companies, therefore, are likely to be well positioned to achieve robust earnings growth. The earnings growth that we expect in the US is roughly double that we think will be achieved in the European markets. And the leading indicators in areas of Europe are still relatively tepid. So we are more positive on the US due to the stronger earnings and macroeconomic picture. But I would also caution that we are alert for any shift in momentum in Europe. We know that Spain, the macroeconomic fundamentals have been strong. In Germany, we expect a shift in government's policy on the debt brake. So this will allow more fiscal policy to be quite stimulative, hopefully, for the market and for growth. And that could lead to a regime shift in Europe. So we are watchful for that. But at the moment, we don't see a clear catalyst coming through. The macroeconomic indicators are still relatively weak on the whole, and the earnings picture is not strong enough to turn more positive on Europe. So we're still more positive on the US. Just a word on Japan. Here we are a bit more positive structurally. This is because of changes in corporate governance, in company behavior, turning more shareholder friendly. But in the short term, we expect more upside in the US. So we're neutral on Japan, positive in the US, and underweight in Europe within our equity positioning.
What key factors support your positive view on gold as an asset in the current environment?
Yeah, so one of the things we expect is that over the medium term, we expect inflation to be a bit higher, rates will be a bit higher than they have been in recent years, and we're looking for more diversifiers in the portfolio because there could be correlation shifts between equities and bonds, for instance, in multi-asset portfolios. So we're looking for diversifiers like gold to be a part of that solution. So we like to have gold as a diversifier in portfolios. And gold also benefits from an environment of heightened geopolitical uncertainty, heightened policy uncertainty on the whole, and more inflation volatility. So this is the reason we like to have gold, both from a fundamental point of view as well as from a diversification point of view.
So thank you for this time, Supriya Menon, Wellington Management. Thank you. Good day, good business. Thank you for being here.
Thank you for having me. Bye-bye.